Welcome to the December 22nd edition of the Live Traders Swing Newsletter. Hey guys, Jared Wesley here of Live Traders. We are back for another edition of the Swing Newsletter. Wow, what a week in the Dow, the S&P, the Nasdaq. It was actually the worst week in the market since 2008 financial crisis. The Dow was down almost 7%. The S&P, the Nasdaq were quite similar. In fact, it was so bad that there wasn't really a sector that was unscathed. Oil was down a lot. Amazon and Google and Facebook and Apple were down a lot. The only couple bright spots were Procter & Gamble and Nike, which had positive earnings, but for the most part, very few stocks were unscathed this past week. And a lot of the reasoning for that is the geopolitical events around the world, China, America, trade war, trade tariffs going on there, as well as the pink elephant in the corner that everybody's been talking about lately, and that is the Fed. They raised rates a quarter point, okay, and they suggested that they would likely raise rates 2 more times in 2019. Now, with all the political events going on, the China trade wars, and the Fed Reserve raising rates, I mean, it's a little bit of a volatile time. In fact, it's so volatile, we haven't seen anything like it in about 10 years. Now, I want to step back for a second, okay, before we dig deeper, okay? I want to step back and give you guys a broader picture here. Now, I want you to understand, okay, that over the history of the S&P 500, which is what you should be watching because the Dow is a really poor indicator of the overall market. The S&P is a much broader indicator of the market. Okay, so what I want you guys to keep in mind here is that for you swing traders and particularly for you core traders, longer term investors, this is a speed bump. This is a hiccup. Even if it lasts 6 months, even if it goes all the way through next year. How do I know this? Because guys, historically, the market is up 73% of the time. That means almost 3 out of 4 years in the history of the market is up. It's positive. So generally speaking, these types of pullbacks don't last that long. Okay, sure, we've had some stagnation periods in the late 60s through the 70s, etc. But if you'll notice, since 1977 to now, 41 years, the market has really only had about 7 down years. Now think about that for a second. That's about 82 or 83% up years. So almost 5 to 1 in the last 40 years, the market's been higher versus lower. So I want you guys to take a deep breath, woo-saw it out a little bit, and understand that yes, things are very choppy right now. Things are very volatile right now, and you're probably a little bit nervous about your 401k, your IRA, your long-term investment accounts. But here's the fact of the matter. Don't be worried, especially if you're under the age of 50. Okay, if you're over 50 and you're 10 years away from retirement, well, your portfolio shouldn't be that aggressive anyway, okay? So if the market's down 3 or 4%, maybe you're down half of that because you're a little bit more diversified. If you're younger, it just doesn't matter. It's gonna bounce back. In fact, when we had that 37% down year in 07 or 08, it bounced back with a 25% up year. And since then, guys, it's been up every year in a row, 8 or 9 years now. So big picture, guys, take a deep breath. This correction in the market was necessary. It's needed. Look, nothing goes up all of the time forever. So use this pullback as an opportunity to perhaps shore up some of your positions and maybe even add to the market on this 15, 20% pullback. I know for some of you think, what? Have you ever heard the expression, when there's blood in the streets, it's time to buy? That is what I'm talking about, guys. All right, so let's take a look at the levels of the SPY and the Qs, and then from there, guys, we'll go on and take a look at a couple of swing opportunities and ideas that I personally have been looking at. Now, remember, swing trading is obviously more challenging in choppy market environments. Now, with the political atmosphere we have and the government shutdown potentially happening, and with the trade war with China, everything is going to be choppy for the foreseeable future. So step back, perhaps lower your risk, lower your share size with regard to how much you risk in your swing trades. In fact, there are even some times of the year, sometimes of the calendar when the markets are choppy like this, that it's better to not swing trade, to stay on the sideline because things are so volatile and so whippy. And here's one more point of note. A lot of you out there only go long. Even on swing trading, many of you out there only go long. This is an opportunity to start learning how to short the markets. This is a potential opportunity to learn how to start shorting certain stocks. You want to be able to take advantage of the market when it's going up, and you want to be able to take advantage of the market when it's pulling back. So here at Live Traders, we're big proponents of trying to stay with the trend of the market, which lately has been up for 9 straight years. So many of you that just started trading in the last 9 years don't have a lot of experience with shorting stocks, okay? Shorting stocks can be as much or even more profitable than going long, okay? So that's something I want to talk about a little bit today, possible short opportunities, as well as a couple on the long side. But generally speaking, big picture, you want to be very cautious and very careful in this market with how choppy everything has been. So let's head over to the computer and start taking a look at a few charts. So now that we've talked a little bit about the macroeconomic events, the geopolitical events, trade wars with China, we've also talked a little bit about the decision-making of the Fed raising rates a 1/4 point and likely to raise more in 2019. Let's actually dig in here and take a look at the S&P 500, the Nasdaq 100, and see what the price points and levels are that we need to be concerned about. And then on top of that, we'll also take a look at a couple of stocks that I've been kind of monitoring and watching that might be good buys coming up for a possible swing trade. So let's take a look here at the S&P 500, the SPY ETF, okay? So if you look at early 2018, which is right here, okay, we finished 2017 and moved into early 2018 on a really bullish spike, okay? But shortly into 2018, by the end of January, early February, we had a pretty substantial pullback, right? The peak was $286.63. We went down to $252.92. That's a pretty big drop there, guys. I mean, you're looking at over a $30 drop, which is probably in the neighborhood of 12%. And this happened in a 2-week period. So a lot of investors were concerned and nervous, thinking perhaps this would be the end of the bullish run. We bounced back to 280. We retested this area with a bottoming tail. And then ever since that point in early April, we've moved higher. We even set a new all-time high. Okay, so it wasn't up until about September, October-ish that people started talking a little bit about a market pullback. So we had an initial 2-week pullback. We chopped around between 260 and 280 for a good 2 months, 2.5 months. And then this week happened. Now, this is what's important to understand here. This double bottom retest that put in a new high in October is very, very important. See, if this double bottom retest only bounced 50% and then went lower, we would have gone from a stage 2 uptrend to a stage 3 double bottom, M top potentially, and then into an early stage 4. But that didn't happen, right? We put in a new high, a new all-time high. So this makes this double bottom an extremely bullish major support area, an area in which the market really shouldn't break. Therefore, when the market does break this area of 253 in the SPY, we have to be extremely concerned about that and potentially think, possibly here, that this bullish uptrend that we've been riding for so many years is over. Okay, so my first thought here when I see the SPY come all the way down to $240 is we didn't just drop below 253 by a little bit. We dropped below 253 by $13. So we're significantly below this area. Now, I'm going to move up to the monthly chart so you can see this a little bit better. Okay, now See the support area right here, that 252, 253 area. Where's the next area of support on this chart? Quite simply, it's down here around the 215 mark, okay? Possibly as low as the 183 mark. But this range from 183 up to 215 is the next genuine support area for the markets, okay? So guys, on the monthly chart of the SPY, all right, we broke 253 and we have support at 215. Well, that's a long ways down. That's a $40 move potentially. And if we do it as a percentage, the peak up here at 294-ish, give or take, I think the exact peak was 293.94. So call it 294. All the way down to a potentially, call it 214 to make the math, is an $80 move. Okay, so as a percentage, if we drop from 294 down to 214, $80 move, we would be looking somewhere in the range, the neighborhood of about 25 to 30%. Now that would be a serious market correction. So the next leg down is to see where the SPY finds support, because there is no support until we get to 214. We have this huge move up. We broke the major support area here. We'll go to the weekly chart again, and you can see the next area is right there, 215, 214, maybe even 220, we'll see. Okay, so you can see the 200 period moving average here on the weekly chart is at 234. So the next reaction that we should see coming up is the 234 area. Okay, so my suggestion to you guys would be to possibly look to buy the market in the 235 area, but, okay, with a shallow bounce. Understanding that if we get to the 235 area, the bounce will likely only be back to 250 or 260. We're not going to put in a new high after coming into this area. So if you want to do a short-term swing trade on the spiders in the 234 area, I would be okay with that. But understand, and it's very important here, you're going to get a shallow bounce, anywhere from $15 to $25. So make sure your stop loss is somewhere in the neighborhood of $3 to $5. $5 is more realistic, and try to get about a $20 move back to 260. Okay, that's about 4 to 1 on your money, which is what you should be getting. About 3 to 5 to 1 on your swing trades, as much as up to 8 to 10 to 1 if you really get a home run. Okay, so that's my view, guys, on the SPY here, that in the coming week, we're likely going to go lower. Now, we might have a couple up days, right? And if we take a look at the daily chart, we can see we've been down 9 days in a row. So we're due for a green day. 9 down days is quite a while. So it wouldn't surprise me if we had a short-term 2 or 3 day bounce before we continue a little bit lower. Now, if we look at the Qs are not quite as bad as the SPY, okay, in terms of the weakness and the pullback level of support. All right, so the support area on the Qs is $150. Okay, it's right there. That's it. It retested over here, and we went through that big bullish run just like the SPY. Well, this week we went as low as 146.72. So pulling back below that support area is not as significant as it was for the S&P 500. Now, we peaked at 187.53, okay, on the Qs, and we're down at 147.57. So we've dropped about $40, guys. That's about a 22-23% pullback, okay? That's a big pullback. We're officially in a bearish market. And again, you can see the rising 200 period moving average sitting at 133.43. Now, quick side note. I am not a big indicator fan, okay, for swing trading, core trading, day trading, anything. The only indicator I use is a 200 period moving average on a 60-minute chart, or a daily chart, or a weekly chart, or a monthly chart. That is it. From the 60-minute up, I will use a 200 period moving. That is the only indicator that I use. It's the only indicator that you need to. Okay, so we can look, guys, over the next week or so, possibly to buy a bounce in the Qs and the SPY for a short-term run. Short-term run meaning 3 to 5 days, and try to get about 3 or 4R, maybe 5R out of it. All right, so now that we understand what the levels are in the market, what can we do with this? Well, here's the rub, guys. We have a long ways to drop on both the Qs and the SPY, okay? And you can see here, the next level for the Qs realistically is about $120, okay, on the monthly chart. So we are going to see a pretty bearish pullback over the next 3 to 6 months, in my opinion. Now, swing trading, we're usually in stocks for about 3 to 5 days, maybe as much as 2 weeks. Anything past 2 to 3 weeks is more core trading, okay? And core trading, usually we're on weekly and monthly charts. So I want to focus more on swing trading here. Now, the problem with swing trading in this environment, guys, is that the market is very choppy and very volatile. So most of the time, it's going to be better to step back for the next month or two. Wait for earnings season to come back in, because we're going to see a lot more blood. We're going to see a lot more red before we see green. Okay, so I want to take a look at a couple stocks, guys, that I've been looking at, all right? And the first one is LOCO, El Palo Loco, guys. So some of you guys are thinking, what? This is like Chipotle Mexican Grill. This is a Mexican fast food restaurant, okay? Now, as you can see, they've had a tough go of it since 2014 or 15. They've dropped from about $43 all the way down to $10, and they've stayed in that $10 range for a while, okay? Now, everybody was trying to pick who's going to be the next Chipotle, right? Well, there is only one Chipotle, but El Palo Loco for a 1 to 2 week trade actually looks pretty good, all right? So they just reported earnings about a week ago, all right? Revenue is up 11% in the third quarter. Their expansion for 2019 looks to be around 15 to 20 new stores, okay? And they're putting out 19% margins, which is slightly down from a year and a half ago, but still very good considering, okay? Now, the other important thing to note here is this pullback is above the moving average. So what we're looking for here, all right, is we have a stage 4 downtrend on the left. We have a stage 1 narrow range consolidation, right? Remember stage 1 out of PTS? That's a quiet, narrow range, okay? And that's exactly what we're seeing here. And then what we want to see is the stock break out of the stage 1 and go into an early stage 2. And then we want to buy the first pullback. Well, it's exactly what El Palo Loco is doing here. So we get a couple wide range bars, okay, back in November, pop up to this area. Now note, this $15 mark right around 15.44 was kind of a line that El Palo Loco was not able to break since July of 2015. So it's been over 3 years since this stock has really been able to significantly get over the $15 mark, but it was also very hard to get under the $10 mark, okay? So now we break above that area. This is the first sign that we might be moving into a stage 2 uptrend. We're not in a stage 2 uptrend, but this is the first sign suggesting, you know what, things might be changing. Well, we've pulled back here for about 4 weeks, but here's the key. The market has been extremely weak during this period of time, extremely weak. But El Palo Loco has not been so weak. So El Palo Loco is actually showing relative strength to the Nasdaq here. And also note where it's pulling back to. It's pulling back to support on about a 30% retracement above the rising moving average. So I'll pull up the daily chart real quick. It'll be a little bit different than this, okay? So you can see the breakout here, right there. Now we're pulling back. We tried to bounce. We're pulling back. We tried to bounce. So notice some of these buy setups didn't work. And this is why I've been talking about this stock on a weekly chart. Because a weekly buy setup is going to give you a little bit more flexibility. So if El Palo Loco breaks over $15.15, you want to put your stop loss around $14, okay? And you want to trade it to your first target of $17. That's about 2 to 1, about. And then your second target, guys, is way up here at $29. Now, here's the rub. This is probably going to be a little bit more than just a short-term swing trade. This has the possibility of turning into a core trade. Because if we do break this prior pivot high right here at $17, there is so much room to go higher on El Palo Loco that you could really run this out to the end of next year potentially. All right, so make sure you wait for it to trigger. Wait for it to trigger over $15.15. Put your stop loss around $13.50 to $14. So you're looking at between $1 and $1.50 on the stop loss. Your first target is about a $2 target, and your second target is big. I mean, the $20 target, this is just, that's a hiccup, guys, that topping tail. More than likely, you can get back up to about $27, okay, $28. So possibly as much as a $14 move. That could, guys, be as much as a 10 to 15 to 1 run. But to get that run, you're going to start it out as a swing trade and maybe then turn it into a little bit of a core trade if it starts to move. Again, I like the fact that it's moving out of a stage 1. It's pulling back shallow about 30%, okay? Earnings are good with this company, even though we don't care as much about that, but it's a good sign that earnings are good for El Palo Loco. Revenue is up 11%. The margins are up 19%. And if it does move into an early stage 2 uptrend, this could be a really good stock moving forward. So please watch El Palo Loco. It's one of my favorite ideas for this week's Swing newsletter. I hope you enjoyed that review on El Palo Loco, as well as this week's Live Traders Swing newsletter report. And don't forget, if you haven't gotten yourself a copy of Trading Plan Essentials, you definitely want to go to the website and check that out. It's only $37, guys, and it's a 65-page manual on how to build a professional, profitable trading plan, written by me, okay? It's a really wonderful book. It's not very expensive. You want to check that out. And if you haven't had an opportunity, download our free ebook at livetraders.com and come check us out in our live trading chat room where we trade stocks, we trade options, we trade Forex, and we also talk about swing trading opportunities.